Difference between defined benefit and defined contribution pension plans. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses the difference between defined benefit and defined contribution pension plans. In this video, you will understand the meaning of pension, the difference between defined benefit and defined contribution plans, benefits and disadvantages of a defined benefit pension, benefits and disadvantages of a defined contribution pension, and considerations for choosing between defined benefit and defined contribution retirement plans. Now, let us start. What is a pension? A pension scheme or system consists of plans, procedures, and legal processes of securing and setting aside funds to meet the social obligation of care which employers owe their employees on retirement or in case of death and disability. It is a structured method of providing economic security to an individual who cannot support himself. A sound pension system ensures that a worker's benefit is paid appropriately based on the rules of the pension plan. Hence, a pension system provides the beneficiaries confidence that the benefits promised are secure and will be paid at the appropriate time. Defined benefit versus defined contribution pension plans. The shift towards defined contribution pension plans now puts more of the retirement planning responsibility on the employee's shoulders and not the employer. Defined benefit pension plan. A defined benefit, also known as pay-as-you-go, PAYG, system, the pension plan is a traditional pension. It provides a defined benefit, which is a pre-specified amount or annuity, either in absolute currency or as a fraction of a measure of past earnings and years of employment. The guaranteed pension benefit could be in either natural or nominal terms. A defined benefit plan is a retirement plan where an employee knows the pension amount of retirement benefit beforehand. In a defined benefit plan, the pension amount is computed by considering employees' salary history and the number of years into service. A defined benefit pension system provides a specific and predictable benefit, or amount of income, at retirement. Essentially, a defined benefit plan offers guaranteed income for life. In a defined benefit plan, each employee's future benefit is determined by a specific formula, and the plan provides a nominal level of benefits on retirement. Usually, the promised benefit is tied to the employee's earnings, length of service, or both. For example, an employer may promise to pay each participant a benefit equal to a percentage of the employee's final 5-year average salary times the number of years of service at retirement, or the employer may pay a flat dollar amount per year of service. A defined benefit plan is typically not contributory, that is, an employer is solely responsible for the provision of pensions to its employees. Moreover, there are usually no individual accounts maintained for each employee. The employer makes regular contributions to the plan to fund the participants' future benefits. The employer bears the risk of providing the guaranteed level of retirement benefits. Defined benefit plan sponsors may choose from several formulas for determining final retirement benefits, including 1. Flat benefit formulas. These formulas pay a flat dollar amount for every year of service recognized under the plan. 2. Career average formulas. There are two types of career average formulas. Under the first type, participants earn a percentage of the pay recognized for plan purposes each year they plan participants. The second type of career average formula averages the participants' yearly earnings throughout the plan participants. The benefit equals a percentage of the career average pay at retirement, multiplied by the participant's number of years of service. 3. Final pay formulas. These plans base benefits on average earnings during a specified number of years at the end of a participant's career, usually 5 years. This is presumably the time when earnings are highest. The benefit equals a percentage of the participant's final average earnings, multiplied by the number of years of service. This formula provides the most significant inflation protection to the participant but can represent a higher cost to the employer. Usually, the formula dictates the defined benefit pension plan and includes the salary, years of service, and the participant's age. The calculation of specific pension uses may differ slightly, but most look something like this. 2% x average yearly pensionable earnings during the highest 5 years 10 years of pensionable service. For example, 2% x $100,000 by 35 years equals $70,000. With a defined benefit retirement plan, the employer takes on the investment risk and responsibility for ensuring that there is enough money in the investments to fund the pension payouts. These types of plans often require complex actuarial projections and insurance for guarantees, resulting in higher administrative costs. While defined benefit pension plans are common, but they are usually only found within the public sector. The risk of defined benefit pension plans is too much for employers in the private sector, so they opt for other options. Benefits of defined benefit pension plans. Employees prefer defined benefit plans, and it is no wonder with the many advantages they provide with minimal risk to the worker. 1. Easier to plan for retirement. Defined benefit plans provide predictable income, making retirement planning much more straightforward. The predictability of these plans takes the guesswork out of how much income participants collect at retirement. 2. Flexible retirement dates. Most defined benefit plans offer an option to take early retirement, usually after 55. The retirement benefit would be reduced accordingly, but a participant could get up to 10 years of the time back, which may prove to be more valuable than the lost pension income. 3. Flexible payouts. It is usually possible to integrate a defined benefit plan with other retirement income plans, thereby gives room to optimize the participant's tax efficiency. This means that the participant retirement income will increase appropriately. 4. Survivor benefits. Depending on the defined benefit pension's specifics, it may include survivor benefits for the beneficiary. If the pension plan does not include this, the participant dies before his or her spouse, the spouse or common law partner may be entitled to a portion of the defined benefit plan. 5. Cost of living adjustments. An added benefit of some defined benefit plans is the cost of living adjustment. Inflation will impact the amount received by the participant at retirement. Accounting for inflation is important because $50,000 a year now is very different from $50,000 a year 10 years from now. 6. Income splitting. After the age of 55, a participant could split the pensionable income with his spouse or common law partner. Income splitting can provide a considerable tax advantage depending on the tax situation of both partners. 7. The employer bears the risk. With a defined benefit plan, the employer carries the risk that the return on investments will cover the cost of the pension amount owed to retirees. In addition, the vesting period for defined contribution plans is typically only a few years, whereas the vesting period for defined benefit plans is often 10 years or more. 8. Portability. Since employer retirement contributions are paid directly into individual accounts under a defined contribution plan, it is easy for workers to take their accumulated funds with them when they change jobs. Upon the employee's departure, both employer and employee contributions can be cashed out and rolled over to a future employer's plan. Under a defined contribution plan, by contrast, only employee contributions may be cashed out. This portability is highly appealing to employees in an age where the average worker switches jobs numerous times during his or her career. 9. Younger worker appeal. Shifting to a defined contribution plan provides benefits to younger workers. Demographic government recruiters are desperately pursuing across the nation. They appreciate a benefit with the portability and flexibility and choose a defined contribution plan offers. 10. Accountability and transparency. The participants manage defined contribution retirement accounts themselves, not a government pension board. Hence, there is complete accountability and transparency about investment decisions of defined benefit pensions. These decisions are simply the responsibility of the individual participant. Thus, there are no backroom deals, no conflicts of interest, and no need to worry about the lack of financial disclosure, which has plagued the pension boards of government defined benefit plans. Disadvantages of defined benefit pensions plans. Although defined benefit retirement plans provide guaranteed income for life, they have some disadvantages for the employee. 1. Working longer than participants needed to. Often, employees with a defined benefit plan work longer than they may need to because they become fixated on earning their full pension amount. 2. Company managed fund. Although the company bears the risk of market volatility, there is still a risk to the employee. The employer needs to manage the fund appropriately, or there may not be money to pay out as pension payments. If the employer mismanages the fund or goes bankrupt, there is a chance the plan member's future pension income could be affected. See as anyone? Ones that are not are worth less money every year that passes. 3. Not always indexed to inflation. Not all defined benefit plans are indexed to inflation. If a defined benefit pension is not indexed to cushion the effect of inflation, the participants should arrange for a secondary retirement income such as retirement income annuities. 4. An employee has no individual pension account. Defined benefit pension contributions are pooled into one investment fund. Plan members can often get projections of their future pension and current commuted value. But employees are not entitled to any of that money until they leave the plan or retire. Defined contribution pension plan. A defined contribution pension plan is one in which the employer and employee make contributions. Employers generally promise to make annual or periodic contributions to accounts set up for each employee in a defined contribution plan. Sometimes defined contribution plans are referred to as individual account plans, commonly referred to as retirement savings account, RSA. The current contribution is guaranteed but not a level of benefits at retirement, as in a defined benefit plan. The contribution to a defined contribution plan may be stated as a percentage of the employee's salary based on the years of service. Sometimes there are only employer contributions, sometimes only employee contributions, and sometimes both. The benefit payable at retirement is based on money accumulated in each employee's account. The accumulated money will reflect employer contributions, employee contributions, if any, and investment gains or losses. The accumulated amount may also include employer contributions forfeited by employees who leave before they become fully vested, to the extent such contributions are reallocated to the accounts of employees who remain. These are called forfeitures. The final benefit amount of the pension is unknown because it is based on contributions and growth rate. Furthermore, the investment returns are unpredictable and subject to market volatility. The administration costs are relatively low with a defined contribution plan because the employer has no obligation to the plan's accounts performance. The employee makes contributions and chooses what to invest in from the investments offered within the retirement plan. Those contributions are invested over time to provide a payout at retirement. Most defined contribution plans offer some form of contribution that match up to a certain amount. If an employee contributes 10% of their gross salary, the company may match 50% up to $10,000. Here is what that would look like for an employee with a $100,000 gross salary. $100,000 by 10% equals $10,000, plus $10,000 x 50% of 10% equals $5,000, equals $15,000. Contributions within a defined contribution pension grow tax deferred, and there are limits set on annual contributions. These limits include both employee and employer contributions. Benefits of defined contribution pension plans. Benefits of a defined contribution pension include: 1. Vested immediately. Many defined contribution pension plans vest immediately or within a short time. Once the participant's contributions are vested, that fund entirely belongs to each participant. So, if a participant leaves the program or change employer, he or she would have options on what to do with the plan's investments. 2. Ability to withdraw or transfer funds. Depending on the rules of the pension plan, participants might be able to remove or transfer funds before full retirement age. This is a valuable benefit if an employee changes employers throughout his career. This freedom of choice is not available with defined benefit plans. 3. Choice of investment options. Employees are involved in investment decisions with a defined contribution plan. In a defined contribution plan, an employee has the right to take decision about the allocation of its asset, that its pension fund. If the employee is aggressive, he can opt for equities. On the other hand, if market volatility makes the employee jittery, he can opt for debt funds. An employee can also opt for a mix of equities and debt to get the best of both worlds. 4. Individual pension account. Each employee has a separate pension account with a defined contribution plan. There is no pooling of funds between employees. Hence, each employee has control over the investment of their funds. 5. Employer match. Although the retirement benefit for a defined contribution plan is unknown, the employer match is much more predictable. Employer match depends on the amount contributed by each participant. The employer match is an instant return on an employee's investment contributions. Disadvantages of defined contribution pension plans. Disadvantages of a defined contribution pension include: 1. Limited funds to choose from. A benefit of a defined contribution pension is that each participant determines what to invest their funds in. Unfortunately, those choices are limited to what the plan offers. The offered investments are usually mutual funds that come with slightly higher management fees. 2. Unpredictable retirement income. With a defined contribution pension, the end retirement benefit is unknown. The onus is on each employee to plan for his or her retirement. Due to the unpredictability, this planning comes with much uncertainty. 3. The employee bears risk. The employee and employer contributions for a defined contribution pension are subject to market volatility. The employee assumes the risk of this market volatility, with their final pension amount not guaranteed. 4. The self-discipline required. Employee self-discipline and savings habits are necessary to ensure that financial preparedness for retirement. Considerations for choosing between defined benefit and defined contribution retirement plans. A defined benefit plan specifies exactly how much retirement income employees will get at retirement. A defined contribution plan only specifies what each party, the employer and employee, contributes to an employee's retirement account. While a defined benefit plan has become increasingly rare, you may find yourself presented with a choice, either as a new employee or as a long-time employee offered the option of enrolling in a new plan. This is an important decision because it cannot be changed once you make the decision. Here are some things to consider if you are to choose between defined benefit and defined contribution retirement plan. 1. Which plan could provide you with the most retirement income? This is a prominent place to start, but it requires a lot of assumptions. Both plans will need you to estimate how much your income will grow and how long you will work in the company. Ensure that you use the same estimates for both, so you are comparing apples to apples. You can then input those numbers into the defined benefit plan's formula to estimate your benefit. For example, if you would get about 40% of the average of your 5 highest income years after working for 25 years. If the 5-year income average is $90,000 in today's dollars, you will get a benefit of about $36,000 a year or $3,000 per month. On the defined contribution side, you will also need to assume an average rate of return on your investments to calculate how much extra you will have in the plan at retirement. For example, if you earned that same $80,000 for the 25 years, received an 8% match, and earned a real, after inflation, average annualized return of 5% a year on your investments, you will end up with about $357,750. Depending on annuity prices, you would be able to purchase an immediate income annuity paying about $1,912.50 a month at retirement too. Do you prefer stability or flexibility? If running the numbers was all that mattered, the defined benefit plan would be more favored. However, there are a few other things to consider. One is that the defined benefit plan might force you to take an annuity at retirement, while the defined contribution plan would provide you with the option of taking a lump sum. The lump sum option might be more appealing if you do not need the security of a defined benefit, if you are expected to withdraw 4% or less from the retirement fund, or just prefer the flexibility of being able to invest and access the money throughout your life and pass the remainder on your dependents or estate. On the other hand, you will not have to worry about investment returns with the defined benefit plan. If you are more conservative with your investments, do not have good investment choices, or just prefer not to worry about them at all, you may prefer the stability of the defined benefit plan. It is worth emphasizing that defined benefit plans do have the risk of your employer not being financially able to pay your benefit, but, at least part of your benefit is likely to be insured by the pension benefit plan. Annuity prices may also be different when you retire, so the payments you get may be more or less than projected. The annuity payments will generally be higher if interest rates are higher and lower if interest rates are lower. 3. When do the benefits vest? None of these benefits matter if you do not work with the employer long enough to vest. Vesting is when the retiree takes ownership of the benefits you have earned. Let us assume that the vesting period is only 1 year for the defined contribution plan and 10 years for the defined benefit plan. That means if you left an employer after 5 years, you would be able to take the entire balance in the former employer and nothing at all from the latter employer. The risk of not wanting or not working for a more extended period with the initial employer tends to favor the defined contribution plan. As you can see, this decision is very personal and can be quite complex. If you are unsure what to do, you should consult a financial planning expert for advice. In any case, make sure your decision is an educated one. Conclusion. The difference between defined benefit and defined contribution pension plans has been discussed in this video. Employer-sponsored retirement plans generally fall into two broad categories: defined benefit and defined contribution plans. A defined benefit plan specifies exactly how much retirement income employees will get once they retire. A defined contribution plan only specifies what each party, the employer and employee, contributes to an employee's retirement account. I hope the video is educative and beneficial to you. We love to hear from you. Please post your comments below in the comments section. If this video has been helpful and beneficial to you, then, give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.